Hello, listeners. Welcome to another episode of Cognitive Dissidence. As usual, I'm your host. I'm Jacob Shapiro. I'm a partner and the director of geopolitical analysis at Cognitive.investments. I don't have a whole lot of housekeeping notes today. Rob and I had a really great chat about what's going on in the world with geopolitics and markets. If you missed the episode on the Democratic Republic of Congo with Ben Shepard earlier this week that was published on Monday, I would encourage you to go back and listen to it. I obviously think every podcast episode we do is great, but that episode with Ben, well, I'm just fascinated by the DRC. That's sort of one of my new hobby horses. But he had terrific insights at sort of getting ground truth or understanding of a country that are really beyond the headlines. That's what we always try to do, but we really succeeded with that, and I appreciated Ben coming on and would commend that podcast to you, even if the topic does not jump out to you initially. Otherwise, you can email me at jacob@cognitive.investments if you have any questions, comments, concerns. I put in a joke at the end of the podcast for one listener who put in some very good concerns. We appreciate you, Mark. Other than that, take care of the people you love. Stay warm. It's cold out here. We're getting an Arctic bomb. I forget what they're calling it. In New Orleans next week. I had to go online and buy a bunch of blankets to put on my plants because otherwise they're all going to die. I'll have to get into the house later too and insulate the pipes because we're not built for that here. But whatever. I'm telling you too much. Cheers and see you out there. I have this new monitor that I look at now, and I have an external keyboard that connects to the computer via Bluetooth, and I shut the computer and shunt it off to the side, but I forgot to charge the keyboard. So now all of my beautiful feng shui on my desk is ruined because I have to have the laptop open because otherwise I don't have a keyboard. But now there are wires everywhere, and you can't see it if you're looking at this in video. Everything looks great, but in front of me I see a complete disaster of cables, and it's stressing me out. Good morning. How's it going?
It's amazing that you maintain such composure given these working conditions.
It is, it's really, I might as well be mining cobalt in the Democratic Republic of Congo. I will say, are you one of these people, shout out to Phil, who, one of my former colleagues, I'm one of these people who has 30 different tabs open in the same browser until I finish whatever project I'm on right now. And every time he sees my computer, he says I'm a sociopath because apparently there's some app where you can collapse all these things together, but I can't do it. I don't know. Are you a tab person, or do you also think this is sociopathic behavior?
No, I'm anti-tab. In fact, I have a tip. I use the Opera browser, which is very good because it organizes your workspaces into different types. So you can have multiple workspaces with different tabs that I organize, but I'm pretty... One of the things when you're an investment person, an analyst, is you're just so anal about avoiding information overload because it happens so easily. So yeah, I like to keep things real clean, close them down real quick.
Yeah, I don't know what that says about me. I hit a critical mass of when I have enough information, and then I stop adding tabs, and then it's like a race between can I get the insights out of my fingertips, or will my computer crash from freezing up from all the memory that's being soaked up? And it forces me to work a little bit. Anyway, this is not the reason that y'all are listening to this podcast, so I'll shut up now. I won't shut up. I'll move into the geopolitics part. The first thing, I don't have a ton new to say about this because we talked about it last week, and I've talked to some of our clients and listeners about this. The Red Sea is still boiling. The Houthis launched their biggest attack this week. Both British and U.S. forces repelled it. It was something like 18 drones. The disruption is starting to show up in macroeconomic trade data. So trade might be down 1.3% month on month as a result of what's going on. Container shipping in the Red Sea, we talked about that picture that was on Bloomberg, but I've got some data to back it up. It's 70% below the average. Usually you've got 500,000 containers in the Red Sea going out through a month. Now it's down to 200,000. I will say that the British Secretary of Defense said that this was unacceptable, and his literal words were, "Watch this space." And the Biden administration has said this is not acceptable, and they've warned the Houthis at the UN and everything else. So maybe they are gearing up to finally do something about this, but I continue to find the delay somewhat confusing. And for now, shipping companies are going nowhere near the Red Sea, and the longer this goes on, the longer it's going to take for shipping to get back to normal. And does that affect, inflation? Does it affect Egypt because they're not getting Suez Canal tolls? I mean, there's just sort of a whole plethora of variables that go off from it. So I don't have a ton more to say because otherwise it's been quiet. There's nothing in the Israel-Gaza war, or no statements from Saudi Arabia or Iran, nothing that gives us anything more here other than that the Houthis are doing their thing. The United States and Great Britain say they're about to take the kid gloves off. But but talk is cheap. So I thought we'd just start and say that. Is there anything you want to go into there, Rob, before we turn to some of our other topics?
Well, the only two things I would add to that are, or that I find interesting in that story are, first, you can see that freight markets are already tightening in response to this. So container shipping prices are rising. We spoke last week about the freight cycle beginning to bottom and turn around already, and the impact on inflation that's having. This is only going to exacerbate that. The other thing that caught my eye, which is really more in your area, was I saw a headline that India was deploying naval assets to the Indian Ocean to apparently deal with this situation. Do you think that is that a real thing? And does it suggest that the rest of the world doesn't exactly have much confidence in the U.S. After all this delay to deal with it?
Well, so I haven't seen the report, but so was the report that they were deploying like around the Indian Ocean itself, or that they were deploying to the Persian Gulf or to the Red Sea to sort of protect Indian interests in that part of the world?
Not clear. It said Indian Ocean, but then it said to address the Red Sea issues. So I don't know. I didn't read the article yet, but caught my eye.
Yeah. I mean, that could be everything from India wanting to participate in, anti-piracy operations and things like that, over and up to, wanting to secure their own energy trade flows. As we know, as a result of the Russia-Ukraine war, India's not very choosy about where it imports its energy from. It still imports lots of energy from Iran. So I don't know. You could see it. You could read it a couple different ways. You could read it maybe as India wanting to be part of the police operations in the Red Sea, or you could read it as India having serious doubts about the capacity of the U.S. and the U.K. and these other actors to defend their trade routes. I do think whether it's the former or the latter, I think in general you're going to see this more often. And if you look around the world, and if you look at the money that different governments are spending on boosting their naval forces, even if it's just sort of local trade. For instance, this is not going to make it to sort of top level of the podcast conversation today. But for instance, the Philippines and Indonesia had a high-level meeting this week. They're talking about increasing security cooperation. One of the parts of the deal was that the Philippines would be buying more ships from Indonesia. Now, Indonesia's not making blue water Navy carriers that you're going to send into the Red Sea, but they are making the types of ships that the Philippines would need to police some of these islands and shoals and atolls and things like that they have problems with the Chinese with, which raises up a whole interesting bevy of questions of what Indonesia's thinking about in terms of China. But the point there is just, you can see around the world that different countries are increasing naval capacity in their own backyards and maybe even further, because they don't quite trust that the way that the system worked before, that it's going to continue to work that way in general. All right, well, so if we move on from the Red Sea, it has been a deceptively sort of quiet week in global geopolitics. We're going to get to Ecuador and a couple of other things after our main sort of topic for the conversation today. But I was most struck this week by a report by the World Bank. I'm giving away my nerdiness right now. It was their 2024 Global Economic Prospects Report. We'll put a link to it into the show notes. It's many hundreds of pages long, and the 24 economic forecast report is replete with all sorts of predictions that I have no idea how they back up. Trying to down to a tenth of a decimal point. Oh, this is what global growth is going to do this year. There were some macro insights that were interesting. I mean, we basically had the worst 5-year performance in terms of global growth since the 1990s. And they're basically calling for much slower growth going forward in general. The last 3 years, global growth has slowed consecutively. They also talked about, and one of the more depressing points was that for 2024, per capita investment growth is forecast at 3.7% globally. That's about half of the average of the last 2 decades. So people are just not investing right now. That's a tangible sign of people are afraid about the volatility and uncertainty in the environment. They don't quite know what to do about it. But the interesting part of the report was not all of those sort of forecasts, most of which will probably be in the dustbin of history and won't be correct. That's how those forecasts usually go. But at the end of this hundreds of pages, they tacked on this very interesting sort of 20-page essay or study about different countries and how they were able to surge investment cycles within their own countries. And they defined investment cycles in very particular ways. It had to be at least a 6-year period where they observed some of these changes. So not a flash in the pan. you had to have annual per capita investment growth over 4% during that time period. So a pretty rapid increase in investment. And your average per capita investment rate had to be 2 percentage points higher than your previous 6-year average. So not just rapid, but really sort of a stepwise increase from where those countries were before. And they did a study of a bunch of different countries going back to the 1950s and teased out, here are the 3 or 4 things that countries have done over the last 70 years to lead to these investment outcomes. And the reason they are so focused on this is because they draw a direct line between, if you get these investment booms, you get less poverty, you get less inequality, you get more income convergence, especially with developing markets. So if you're a poor country, you're sort of getting a lot richer, going up the value-added scale and things like that. And then your infrastructure gets much better. One thing that they did notice during the 2000s, 42% of countries in the world had at least some of the qualifications they needed to be included in the study. So almost half of the world was investing, was growing. There was sort of a general sense of optimism. From 2010 to 2022, only 25% of countries had some of these signs, and almost all of the emerging market countries dropped out. So it was all just already developed market economies kind of, building, going from strength to strength and things like that. And we can talk about some of the case studies, but I wanted to give you just sort of the 3 or 4 main things that they said that went into these investment booms. The first was fiscal consolidation, which is a mind-numbing term, which just means not being so profligate, not spending more than you actually make. So this is things like reducing deficits, inflation management control, getting rid of costly subsidies for the government if they have them through. Every country that does this has some period of fiscal consolidation. Structural reforms was the second, and that's mainly geared towards easing cross-border trade flows and allowing capital flows to be easier across borders. Now, there's a lot of different ways this can work. For instance, Turkey is one of the countries that's on their list. Turkey had one of these investment booms that they talked about from 2003 to 2008. For Turkey, the structural reforms were all about stability, which is ironic when you think about the last couple of years with Turkish monetary policy. But that was Erdogan's sort of first couple of years in government, and he had to stabilize the situation. He had to give people confidence in the independence of the central bank. Contrast that with India, which is on the list. It had a period from 1994 to 1999 where it wasn't really about stability. It was more about shortcomings within the Indian state within itself. So you had a bunch of bloated state-owned enterprises that had to be privatized, for example. That's the kind of structural reforms they were talking about. And then the last 2 variables, the first was, generally speaking, for most of these countries, these were not piecemeal reforms. It wasn't like, oh, we're going to try this one, and then we're going to course correct, and then we'll try another one. It was a big package. They basically took out the bazooka and said, we're doing everything. We're ripping off the Band-Aid, and it's all going to happen at once. And there was pain, and there was, a couple years of craziness, but eventually you get that investment dividend on the back end. And then high-quality institutions, surprise, surprise, it's not necessary to do this, but it really, really helps if you have high-quality institutions. And if you can improve the quality of your institutions, you're probably going to get some of these investment cycles to be a little bit better. So I'll pause there. You haven't seen the report. Some of the countries that they called out in their case studies were Malaysia, South Korea, Poland, Turkey, Colombia, Chile, even Morocco. Uganda was the one that stuck out like a sore thumb. Uganda had an investment acceleration increase from 1993 to 2012. The longest of sort of these countries that it called out in its case studies. And I don't think of Uganda as like this, beacon of investment in sub-Saharan Africa or developing markets in general. But they had some of these things, at least for almost a 20-year period there. So I thought I'd just pause there and throw that back over to you. And when you're thinking about global markets, does that line up with what you're thinking? Do you want to take any issue with it? Take it any direction you want, Rob.
First, you have to acknowledge that the World Bank is talking its own book. So the World Bank is the institution for sort of traditional structural reform, policies and approach, what used to be known as the Washington Consensus. So if you look at what they highlight, there's a lot of nuance that is being missed, and I think there's a lot of selection bias. Like, they're looking for these very specific criteria, but oftentimes they're missing times when countries did what should have been the right thing and it didn't work out. So take Turkey for one specific example, right? So the period that they're referring to in 2003 to 2008, Why did that happen then? Well, let's look at the previous 20 years of Turkish economic history. Turkey went through a liberalizing period in the 1980s after the end of the military regime. And they had a lot of success in the early 80s, and they sort of went through the final stage of that reform in, I think it was 88, and they liberalized their capital account under pressure from the IMF and the World Bank. They opened up and liberalized their capital account, and it was a total disaster. Capital flows flew into the country. There was a brief investment boom, and then they flew back out because there was a lot of malinvestment. And the 1990s were sort of a roller coaster of nastiness and chaos and political instability, and not much real progress in Turkey. And it was only by the end of that 1990s decade that things hit their worst, when they had hyperinflation. They had the IMF gave them a bailout and tried to peg their currency and inflict even more traditional medicine, so to speak. And that itself was a disaster. They pegged the currency at the wrong rate. They had another destabilizing capital boom as money flew out this time because of the way that it was pegged. And they had a 2001 just disaster. So that's the background to Erdogan's election and his decision to pursue sort of the policies that he did. You could have said the same thing in the 1980s, the 1990s. It's not as simple as, you just have good institutions and do X, Y, and Z and you're good, So that is, that I think also explains why they say, there's usually the case that all of these reforms happen together. You have a big bang reform, a broad mandate to do a lot of stuff. Like you said, it's not just piecemeal. Well, the reason why people or politicians get broad mandates to institute these kinds of reforms is because whatever came before that was such a disaster that people are so hungry for change that all of a sudden, the elements come together and you can do radical things. So again, selection bias, what sort of time periods are you capturing with this analysis? The other thing that I think the analysis misses is cases where you had investment booms that turned into disasters for other reasons. So look at Brazil in the 1970s. Brazil in the 70s was the darling of the development, finance community. They had an investment boom. They had high single-digit GDP growth. Everyone was sort of saying, finally Brazil is coming into its own. And it was sort of malinvestment. It was invested into sort of vanity projects, white elephants. And when you had the Latin American debt crisis emerge in the early 80s, it all came tumbling down, and Brazil and a lot of its neighbors suffered, a 10-year-long decade, very similar to what we're experiencing now with, some of the debt issues as far as workouts and how do you deal with the China issue, for example. It's the same thing that you saw in the 1980s with, the Brady bonds and this whole process. It's not a new story. So I guess my takeaway to summarize all that is I don't see a lot of value in this analysis. I think it misses a lot of things and it oversimplifies a lot of things to pursue an agenda.
As all analysis does. God, I would hate to hear what you really think of some of my analyses that I write. But no, I take your point. I mean, there are a lot of shortcomings to the study. For example, I read some of these countries, or I mentioned some of these countries that they used as case studies. Any one of these booms that ended in 07 or 08, I sort of automatically was like, okay, well, that's like obviously something else is going on there. Like there was a global economic crisis. Maybe actually some of these countries were engaging in really irresponsible investment or doing things that were not that wise. So you can cross off North Korea from 99 to 07, Colombia from 01 to 07, Turkey from 03 to 08. They don't work. Malaysia was a great example of some of what you're talking about. So Malaysia has one of these investment booms from 88 to 97, which, of course, 97 is the Asian currency crisis. And the World Bank report even says in like a 1 or 2 sentence euphemism, yes, Malaysia did great, but they did not have enough controls for financial excess. So even though they did a really good job at the beginning, the thing unraveled in front of them and blew up in their face. But there are a couple examples, and there are other examples on the list that are not related to global financial crises. For example, Chile is on there from 86 to 93. That probably has way more to do with copper prices and sort of global interest in a particular commodity that country had than anything else that they were doing at home. That said, there are a few sort of countries on the list where it is sort of interesting. Like Uruguay from 2004 through 2014 is one of the ones that checked all the boxes here. That's an interesting time period. Maybe we should go study what Uruguay was doing through that decade, through the great financial crisis, still managed to keep investment at those high levels. India's on the list from 1994 to 1999. Sure, maybe the tech bubble has something to do with that, but that's an interesting time period for India to be flashing green on all the indicators that they laid out. I said South Korea 99 to 07. Okay, throw that in the great financial bucket. But they also have a nice little jump in the mid-80s when the South Korean government is going after structural reform in a major way. So I think that the study itself, obviously, it's not going to give us any kind of ground truth, but it does maybe point to some case studies for what did this country do over this time period. Maybe there is some secret sauce there to learn. I think the bigger problem for the study, though, is they talk about global conditions a little bit and what types of conditions have to be there globally for some of these countries to have that. And they talk about institutions. They talk about undervalued currencies generally correlate with some of these investment booms. But then they also talk about global growth, the global growth environment at least being benign and more, preferentially more being open. And I think that's the hardest thing here, because when you go to their structural reforms, again, it was all about easing cross-border trade and about greasing capital flows, making it easier from capital to go one place to the other. And I think the thing that the study really misses is that's not the world that we're in anymore. So I went and pulled some data on trade protectionism. If you look at just sort of the absolute number of trade restrictions, tariffs, things like that, over the last 10, 15 years, they've increased by a factor of 6 since 2013. So we've gone from maybe 500 trade restrictions in a year to over 3,000 in the last year that we have data for this. I was also, when I was looking at the data, it was really interesting because it broke it down between goods, services, and investment restrictions. And so protectionist measures related to goods really started their upward trajectory around 2015. But for a couple of years, it's really just goods. Services and investment is really untouched. Then around 2018, that's the height of sort of the Trump trade war, I would have probably associated with that, services restrictions start to come into play. So you can see governments playing whack-a-mole. We did goods, now we're doing services. And in some ways, the most interesting part of the data was that 2022 was the first year where you get a big stepwise increase in trade restrictions that go after investment and investment flows. So if the World Bank is giving you this sort of recipe for how to increase investment into your country, and one of the most important things is, well, you have to ease cross-border trade and make it easier for capital to move from one place to the other. But the world is going the complete opposite direction. Probably you're going to have trouble there. So I take your point, but I do think it is interesting to think about some of these variables and look out at the world today and say, okay, well, what countries might be able to do this? For example, specifically the part about it being a package of reforms rather than just piecemeal. I couldn't help but think of Argentina. And in some ways, Milei is a joke, and I've joked about him on the podcast before, and we're going to have Elo and Ignacio back on next week. We'll probably joke about him and his shitty Rolling Stones cover band from his youth when they come back on as well. But he laid out an omnibus bill of packages and reforms that he wants to force through the Argentine system. He probably won't get more than 20% of them through just because he has a hostile legislature against him. But he's going for the whole thing. He's not doing just sort of this one or two piecemeal thing. And you start to look at Argentina, maybe that has the sort of flavor or profile of a country that can surge this kind of investment growth. Because I think the one really valuable thing from the study was showing you, and maybe causation is not correlation, but showing you, yes, if you can get people to invest in your country and you can increase per capita investment in your country, there's going to be less poverty, there's going to be less inequality, there's going to be better infrastructure. And those are probably some of the national markets that we want to be investing in. So I wouldn't throw the baby out with the bathwater per se.
No, and I would classify all of those stories, I think you can classify into 3 buckets, right? The first bucket is what you're describing, It's the Milei situation, where you have a country that has terrible institutions that are dysfunctional. Things are just terrible. And you have a mandate, because things get so bad, to just do a clean sweep, implement a lot of reforms. India, I would say, was a similar thing in the 1990s, where the license Raj was reaching extremes of inefficiency, and they had a mandate to come in and finally change things significantly. Similarly, to some extent with China and its reforms of its state-owned enterprises in the 1990s, similar kind of situation. So you have that. The second type is what I would describe as the greed inflation booms. So this is the Asian miracle of the 1990s that turned into the Asian financial crisis. This is, to some extent, the emerging market commodities boom of the mid-2000s. It's Russia after the fall of the Soviet Union, when every cowboy on earth is going in and seeing the opportunity to, make $1 billion in sort of this free-for-all. Those are a little bit different, and sort of what I'm trying to get at is, those are clearly less healthy, and they're external driven. So if you think about the Asia situation, for example, that's a perfect example. Asia has a history, Southeast Asia in particular, of investment booms that go on for a while, inevitably run into sort of problems, bad credit, bad investment, extrapolating too much positivity into the future, and then the capital flows out. But in every case, like you describe, it's outside capital. It's people like us sitting in New York or London who all of a sudden, now it's the new thing. Hey, Thailand is the country for the 21st century. Like, it's always a story like that. And, as you say, we're moving in a diametrically opposite direction from that. The headline on Bloomberg today that I saw was, fund managers are concluding that China is no longer necessary to be part of the, investment universe. And I think you can say very similarly with a lot of emerging markets and countries like that. Like, we are not in a period where people are excited about emerging market stories, and that's good. And they're closing down the capital flows at the margin. And I think ultimately that's probably good, because one of the things that's under discussed in our world is the destabilizing influence of unchecked capital flows, and historically how that's really led to worse outcomes over the longer term. The third sort of development story, if you have, disaster turning into a mandate, number one, if you have sort of capital flow, greed, investment booms, number two, the third one is the state-driven investment model. And I think, we talk about this a lot, this notion of knowing how to do things, of savoir-faire, as the French would say, like literally just knowing how to do stuff. And I think the Korea example that you gave, I always talk about this, and I'm going to talk about it again, is such a wonderful example, because that was such a blatant example of them making a conscious decision to learn how to do stuff. And Japan was exactly the same way. In the early part of the 20th century, Japan literally sent bureaucrats all over the world to learn how everyone else in the developed world did their stuff, and to copy it. Copy the good stuff and ignore the bad stuff. That is sort of the third model, and I think that's the model I would be long for the next 20 years, because that's where we're going. When the capital flows, the spigot turns off or turns down. I think increasingly you're going to see more countries seek to pursue that option for lack of a better one. It doesn't mean that everyone will or that everyone can, but I think in the current environment, it's increasing the probability of another growth miracle relative to where we are coming from. Another Korea, another China, another Japan, which are really the only growth miracles that we've seen. The rest of the world has not really caught up with the developed world in terms of per capita GDP. They've grown, but over, the course of the last 2 or 3 decades, they've not gained any ground, which is extraordinary and depressing because the gap is so wide. So anyway, that's a silver lining on the 180-degree turn away from what the World Bank would have everyone do.
Yeah, I'm not so sure that people are as afraid of emerging markets as you think. So for example, like when I was doing some of my normal reading this week, like the IMF was trumpeting that 6 out of the 10 fastest growing countries in the world in 2024 will be sub-Saharan African countries. And you start like poking around and it's like people are looking for the next big thing. It's also, we talk about this too, it's actually very hard to invest in some of these countries. You can't just go and invest. Like for example, there was only one Nigeria ETF that I knew of. They're actually liquidating it. I looked at it the other day, and it's like not anything that you can actually do. You're not actually getting exposure to what's going on in Nigeria. If you actually want to invest in an emerging market, well, you have to go there, and you have to know whose hands to shake and which bribes to pay, and what regulations you have to solve, and things like that. So, there probably are people who are making a lot of money in emerging markets doing that sort of thing. But to your point, the guy trading either at a desk in New York or in his mom's basement or something like that, like you're not going to in public equity markets probably capture these things, especially where we are. I'm also struck by if you go down the World Bank checklist, fiscal consolidation, structural reforms, credibility of independent monetary policy, blah blah blah. The United States ticks none of these boxes right now when it comes to its economic policies. Credibility of monetary policy. Okay, I don't think that anybody thinks that the White House is dictating to the Fed, but the Fed got inflation wrong twice in a row, and I think people are doubting the Fed, and we're going into an election cycle. So I think credibility of monetary policy is not great in the United States. Fiscal consolidation, what a joke. I mean, we're cutting taxes and increasing spending and everything else, the quote-unquote Inflation Reduction Act. There's no structural reform happening because Congress is sort of squabbling with each other, and trust in public institutions in the United States is declining. So let's hope that this recipe book is not accurate, because for the United States, it doesn't paint a good picture. And I think in some ways that also tells you, we talk a lot about multipolarity and how the United States is not leading the way. The United States is still a very powerful country, and a lot of people still look up to the United States. And I think when Americans look out at the world, I say this all the time when I'm giving speeches and presentations and things like that, the world in some sense is a mirror. Like, it's not that the world is going crazy around the United States, it's that the world is sort of emulating the United States. So if you're getting all of these things that are happening, maybe look back to which country started the trade protectionism avalanche, and which country is continue to pushing trade protectionism, even if the rhetoric doesn't quite add up. So I think that's another thing maybe to throw in there.
But it's a recipe not for the United States or for Europe or even for Japan, for that matter. It's a recipe for catch-up growth. And you can tell because the nature of the language used, it's like the World Bank is teaching these governments how to pretty themselves up for the ball. How do you attract the eye of the guy in London? Oh, their fiscal deficit has come down. Wow, that's nice. And implicit in that approach is this notion that you're dependent on outside capital, right?
Yeah.
So when China began its process of sort of its current model that it's been on now, arguably in the 1990s, early 2000s, they were not viewed as some sexy emerging market. This was not an outside capital. China didn't grow because all of a sudden the people in New York decided, hey, now we're going to put all of our capital into China. They used a different model. So in a similar way, the U.S. is in a similar situation because we're not dependent on outside capital. We have, almost infinitely deep capital markets, almost infinitely, because at some point we'll reach the end and we'll truly reach the scarcity of capital. But when that happens, shit will really be bad, and we'll be hiding in a bunker.
Yes.
But it's implicitly self-reliant, and I think that's the key issue. So many of the U.S.'s issues and its problems with its integration with the rest of the world is not about attracting capital from the rest of the world. It's about changing those sort of weird distortions that are happening because all this capital is flowing into the U.S. from the rest of the world. Like, think about that. why the heck would poor people in the rest of the world, comparatively speaking, own U.S. Treasury bonds? Why are they investing in the U.S.? Shouldn't they be investing in their own countries?
Yeah. And I think your point about self-reliance is also really critical, because before, in a globalizing world, it is the Malaysia model that works, or the China model. But to your point, like I keep on playing with the idea that now it's the self-reliance model. It's another reason why Argentina looks so attractive on paper, because yes, it's been a dumpster fire. Yes, the institutions suck. They can grow their own food. They're embarking on a shale revolution of their own, so energy is not going to be that big of a deal for them as they get going. They might even be a net exporter. Like they can, if they get the house in order, they have all the things that you can't. No policy is going to put food on your table. No policy is going to create energy for you. So, in some sense, the profile of the countries that we're thinking is good as a country that can be self-reliant, that doesn't have to be so exposed to some of these other things. Whereas, you asked me about Malaysia on the research chat earlier this week, and I haven't answered you yet. But my answer to you is going to be, I don't care what the chart is saying. Like Malaysia's strategy was for an old world. It's a disappearing world. It's not going to do anything in this current world. They have to switch.
There's a guy named Sidney Homer who wrote The History of Interest Rates, which every finance nerd has to have on their bookshelf. And he had a wonderful quote that I always liked, where he said, the capital demand of the Congo, and he was writing this in like the 1970s, but he said the capital demands of the Congo are infinite. They'll take whatever you'll give them. The amount of capital invested changes on the margin because of how much people want to give them. And I think that's, it gets to the self-reliance thing. If you can have your own capital, you don't have to rely on that. But also it gets to, the nugget of truth in what the World Bank is saying. And in cases like Argentina, where if you do, set the table right and tell the story right, then you can have these booms that are driven, and there's money to be made in anticipating those. You just have to be cautious, because often they're not super efficient.
Yeah. As listeners know, I've been on a little bit of a Congo rabbit hole, and I can't help but I was reading about the Congolese rainforest last night and how it's the greatest carbon sink in the entire world, even more so than the Amazon. So they have the greatest carbon sink and also the greatest capital sink as well, based on what you just said. The last thing I'll just say before we move on to other things, the other thing that was in the World Bank report, and this was in their 24 forecast, moving away from the study that they did, was that at the beginning of the 2010s, the World Bank and the IMF and the UN, they were talking about three main things. They wanted to get rid of poverty and food insecurity. They wanted to eradicate global diseases. And they wanted to cut greenhouse gas emissions by half. And the World Bank report lamented that none of these things have happened. And they're right. Poverty has increased in the world. Food insecurity has increased in the world over the last 10 years. Diseases eradicated. Not only are we not eradicating diseases, we had a global pandemic which caused political fractures throughout the world that we'll probably be dealing with for generations, let alone the trauma from economies and everything else that's going to come from it. But if you want a silver lining, greenhouse gas emissions have not been cut by half. I'm not even sure that's a realistic goal. But the IEA put out its annual report this year, and the world added 510 gigawatts of renewable capacity in 2023. That's 2 times the amount we added in 2019. It's equivalent to the power capacity of Germany, France, and Spain combined. So I'm not saying this from an ideological or sort of green point of view. I'm just saying, when you're thinking about energy prices and where things are happening with energy, we're finally beginning to reach that period that I've talked about before, where there's a bunch of LNG projects that are going to come online in the next year, 2, 3 years. We are finally starting to see exponential increases in the amount of renewable capacity that is coming online. So I think the conversation about energy is going to be very, very different here 3, 4, 5 years. We're talking about it from a deflationary point of view, and I did think the World Bank was wrong to dismiss that, because that is something that's happening, and it is going to affect things in both the short and medium term.
Yeah, I think it's playing out your notion that there's no one size fits all or one single recipe for the energy issue. It's going to be dependent on local conditions. And, on the one hand, we're seeing renewable deployment, specifically in solar. I mean, that's the big one. growing exponentially because it's a general purpose technology. It's growing because it's getting cheaper and cheaper and cheaper every year. There's an economic reason for it. So, a lot of the incremental demand is getting mopped up by that. But then you're right, you're also seeing LNG, growing in leaps and bounds, the volume of trade. There's a lot of projects in the US alone coming on this year. The US has just become the largest LNG exporter in the world. Hydrogen, people were crapping all over us for saying that we thought hydrogen had a significant role to play in the future. A year and a half ago, whenever it was, that is coming to pass. There's clear momentum behind hydrogen, building out the infrastructure. It's a panoply of different solutions for different geographies and different areas, but it's definitely something to be optimistic about.
Yeah. Moving on to other parts of the world. Well, since we were just on an optimistic note, maybe let's do the optimistic thing and then let's do the pessimistic thing. We probably won't talk about this.
Let's skip Uruguay for now, or Ecuador, I mean.
Ecuador, we'll close with Ecuador. Just a few words about Germany, in part because some people came at me on social media about Germany, and I don't know why they did, because they were basically like trying to dunk on me by saying I was wrong about Germany when I've actually been pretty good about Germany the whole time. Like I didn't know how to respond to them because I was like, you're just giving me data that shows me that I was correct. Anyway, some German data doesn't look particularly good. Industrial output has been down 6 months in a row. The government political situation is still kind of a dumpster fire. But for November 2023, they just announced this data for exports and imports. We had a 3.7% month-on-month increase in exports. That's still a 5% decline year on year, but hey, like you got to start somewhere with change. The more interesting thing, though, is that the trade balance has now gone way positive. So we're now talking about a roughly 20 billion euro trade surplus in Germany. About 14, 15 months ago, that surplus had become a deficit. And when I was giving speeches around that time, one of the first charts I was showing was, wow, look at this German trade deficit. Germany hasn't had a trade deficit in decades. This is telling you about the challenges that the German economy is facing and all the things that this is going to push Germany to do. So I don't think that Germany is waking up quite yet. Like, I'm waiting for Germany to put on its big boy pants and decide that it has to support Ukraine with military production and everything else, and for them to stop squabbling in the traffic light coalition and to impose real reforms that they need to push things through. Like, I don't think we're there yet. I think some things have to happen, and we laid that out in our big In Focus piece on this a couple of months ago. But I will say, like, that was an unexpected data point. Nobody was expecting Germany's trade surplus to be that big, or for exports to go up month on month quite that much. So it's not the end for Germany, and some of it might be energy prices continue to be low, a very, very mild winter in Germany. You put all these things together, like, they've been lucky in some sense. But just a little nibble of optimism here. Maybe Germany's darkest moment. Or maybe it's bottoming out. I don't know. Anything you want to say there?
I think Germany has a lot of issues, as you mentioned, politically more than anything, and with regard to sort of finding a coherent voice and a coherent role to play. But this notion that their decline in industrial production in the last year and a half is some existential, problem, or that Germany is screwed, or that it's the end because of the energy issue. Like, as you pointed out, there's just no evidence for that. And the people who are looking for evidence to tell that narrative, because they want to tell the narrative, they're focused on industrial production. But the background is China just had, we're coming out of the COVID shutdowns in China. And then you had a very weak manufacturing rebound in China that then quickly sputtered out. China is Germany's biggest export market and the biggest consumer of its capital goods, which drive the German industrial sector. At the same time, the last 18 months has seen a pretty significant decline in U.S. manufacturing and auto sales and those sorts of things. So everything that Germany does has been in a deep downturn cyclically. So people are taking cyclical data and they're trying to tell a secular story about it. And I think, this one data point on exports is a key one. Look at what's happening in China. Now you're starting to see growth dig in a little bit and rebound. The proof will be in the pudding. If external conditions improve and Germany's still in the dumps, then I think you can make the case that, there's some major structural thing that's changed here. As it stands, I don't think you can make that conclusion at all. So, again, people are going to dunk on you or dunk on that notion because they want to tell that story regardless. But I don't think it's really supported in the data that we've seen.
Yeah, and you're almost too right. I'm about to correct you on a very small thing, but you're almost too right, because Germany's exports to China have gotten so bad that actually the United States is Germany's largest export market, or has been for the last, I forget if it's the last 12 months or 18 months or whatever it is, but that actually shifted recently. And German exports to the United States were actually down in this latest reading. So it's Germany exporting to Europe, other parts of the world. So, again, I'm saying you're too right, even though that little thing was off, but I'll just say that. We got to move on now to Ecuador. There's nothing particularly heartwarming about this story. If you haven't been watching what's going on in Ecuador, basically a bunch of gangs are attacking the state itself. One of these gangs attacked a television news broadcast that was happening in real time, and they were broadcasting the fight in broad daylight. So really, really disturbing. And Ecuador has been on a downward trajectory for a while now. I don't know that there's a huge amount of geopolitical import here, but it's such it was so, what's the right thing? It was so visceral and so strange to watch, and it is in the United States' backyard. I mean, this is supposed to be the part of the world where the United States is the regional hegemon, things like that. I thought it was worth looking at it a little bit. And I don't necessarily have the answer for why Ecuador has deteriorated so much, but it absolutely has. So the murder rate in Ecuador from 2008 to 2022 has gone up by 4 times. The number of deaths from violence in Ecuador last year, it doubled. So over 8,000 deaths. It was more around 4,000 the year before that. The President Daniel Noboa, I believe that's how you pronounce his name, he's 35 years old. He was brought in sort of a mild version of El Salvador's Bukele, where he wanted to go after the gangs and the corruption and the violence and things like that. But boy, is he being tested early on in his presidency. He's declared a state of emergency, which his predecessor did before, but he also has declared this an internal armed conflict. And the streets of Ecuador, according to all reports, are closed. The schools are closed. It's almost like COVID-19 pandemic lockdown as the Ecuadorian army does battle with these gangs in the capital, in Quito, in major port cities, really throughout the country. This is not an isolated thing. And the thing that I don't quite have to understand here is that, so a lot of these gangs, obviously they're in the drug trade, and specifically the cocaine trade. And Ecuador it's not a big producer of cocaine. That distinction goes to Colombia, Peru, and Bolivia. But Ecuador is sandwiched right between Colombia and Peru. And I guess the security situation has improved in Colombia and Peru such that now Ecuador has become sort of this transit point for cocaine as it goes everywhere throughout the world. And if you, I don't know how the United Nations Office of Drug and Crime gets this data, but if you go back to 2014, since 2014, the global manufacture of cocaine has doubled. So we're consuming a lot more cocaine in the world, apparently. And I also thought it was interesting, this is sort of a tangential aside, West and Central Africa is becoming a major transit point for cocaine as it goes throughout the world. So it goes from Ecuador or some of these places, gets to West or Central Africa, and then goes out from there. And that makes me think it's not a coincidence that you're seeing some of this violence in Ecuador versus all of the violence that we've seen in the Sahel and in West and Central Africa. I mean, those are prime smuggling routes for wherever you want to go. And the Russia-Ukraine war probably affects some of these things as well. And sort of the last point here that I read, and this was also in this UN drug report, we'll put a link to it also. It talked about how the Mexican cartels have also changed some of how they've operated. So in the past, Mexican cartels would basically set up shop in a place like Ecuador. So cartel members from Mexico would go there. They'd have a permanent operation. They would be overseeing things on the ground. And they've discovered outsourcing. So they don't want to go there and do it themselves. So they're dealing with local cells and local quote unquote contractors who they rely on in their specific regions to get the drugs from point A to point B, and then they do it. And one of the reasons that's bad is because if you go from large cartel organizations to local cells and contractors that are all competing against each other, these gangs that are fighting for turf, that's a destabilizing situation from a violence perspective, because now there's not sort of a big, overarching force that controls all these things. It's people are competing for the things on the ground. So I think that's some of the reason that Ecuador has gone the direction that it has. I am conscious of not wanting to reduce Ecuador to a drug conflict. Obviously, Ecuador is more varied than that. That said, when gang members are attacking TV crews as they're broadcasting and the army is out in the streets doing battle with them, it's sort of hard to take that point of view, because the people themselves the economy's not working right now. They're all at home. So that's the depressing bit about Ecuador. I don't know if you want to go into that or if you have anything about investment flows of cocaine or anything like that. But that was another rabbit hole I had to go down this week.
Well, I have two thoughts on that subject. The first is I have two analogies. And the way that I think about this, just from a structural perspective, analyzing it, the first analogy is think of the drug trade almost like the Catholic Church. It's a very powerful supranational organization that crosses borders, that is not accountable to the state per se, and has its own sources of power that sometimes break out into squabbling and conflict. But it's sort of a shadow of the official government. The other analogy is I think it's helpful to think of these things in business terms. These are businesses. These gangs make money because they're involved in business. So this is related to what we spoke about a while back on Mexico, and sort of how as the market has consolidated, so to speak, in Mexico, things have quieted down. Violence has declined. And what you're just describing is, very similar to the way you would analyze supply chains in a business. So, okay, you have a very stable oligopoly in Mexico. There's 2 or 3 gangs that matter. The market share between them is pretty stable. So they're not going to be killing each other as much. Whereas here in Ecuador, farther, upstream on the supply chain, it's a much more messy and competitive situation. As you said, they're outsourcing to smaller outfits. There's not as much stabilization there. The state itself is weak, so you have this shadow, power structure that's fighting within itself. It's important, and yet it's not. Like, if you think of Mexico and Brazil as the two sort of think of them as Amazon and Facebook, like 2 giants that control their part of the supply chain. Like, there's not a lot of competition. In Brazil, it's the PCC, the Primeiro Comando de Capital. Like, that's a big business. Those guys are disciplined. You're not going to be screwing around with them. And that's why the amount of drug-related violence in Brazil has actually gone down, even as the drug business has boomed in terms of revenue and profitability. So you're going to see this emerge in areas where the supply chain is less consolidated, less structured, where there's more competition. And in the drug business, competition means literally killing each other. But it's at the same time, so it's relevant, it's big, it's interesting. It's going to change depending on how the industry structure changes, if you want to continue with that analogy. But it's always going to be limited by the size of that industry too. Like, yes, cocaine production has doubled, especially in Europe. Consumption has really grown, and I think it's because the price has gone down as these supply routes through West Africa have really opened up, and the friction there has gone down. But if you look, the total industry is like a $500 billion business globally. So, that's like Walmart globally for all of the drugs. So if you think of it that way, it is an important thing to monitor, but it's always going to be capped in terms of its size and impact, because it is a business. It's not just, doing violence in a vacuum in most of these cases, or at least not at scale.
Yeah, and in some sense, it might be telling us more about Colombia and Peru and about the stabilization of the situation in those countries than it does about Ecuador itself, because probably one of the reasons that things are going to Ecuador is because things have gotten harder for those actors in Colombia and Peru as well. But yeah, I mean, this is the reason you're here for this type of content, folks. Comparisons to global cocaine trade and the Catholic Church, and it came from the Catholic, not the Jew, on the podcast. So I can't claim any credit there. I don't think we should get into our AI chat. I think we should save that for next week. But the last thing I just want to say, because this is something that I focus on, and we have focused on sort of a lot here, is we talk about how the United States is getting unhealthier, it's getting more obese, infrastructure is bad, education is bad, we're going into this election cycle, and everybody hates all the options, but these are the options that the people chose in the first place, all these bad things. But the crime data for 2023 got published in the last week, and it was great. The number of murders in U.S. cities fell by more than 12%. That's the biggest national decline on record. The spike that started in 2020, it looks more like a blip. So now the murder rate is lower than it was in the 70s, 80s, and 90s. And violent crime in general is near its lowest level in 50 years. And I don't have sort of the explanation for this, but I've said this before. I think we're headed towards this big political moment in the United States where there's going to be change, and I've compared it to the 1970s and the 1920s and the 1850s. But the thing is, in those moments, things actually were bad. The economy was not doing well. Like, you had all of these, think about the 60s and assassinations and drug use, like all when we're thinking about, the murder rate spiked back to the 60s, like that's why we're thinking back to the 1960s and things like that. But the economy is good. Like, the United States is running too hot. Like, that's the problem, is that it's too good relative to what the expectations were. We're not fixing any of our education or any other issues, but apparently violent crime, that was just a COVID blip, or I don't know how to explain it, but crime is going down. And yet, I travel around the world I travel around the country talking to audiences. Like, pessimism is so high. And when you turn on the TV, it's all, what's the bad shit going on? It's not that things are getting better. So I don't know. I just thought I would throw that in there because there's a data point that tells you that things are actually not that bad. And the depressing thing for me is that you probably don't get a big political shift in the United States until things actually get bad. Whereas now we're just, we think they're bad, but the data itself, like, yes, there are problems, but it's not like wholly bad, and there's even some improvement around the edges. I don't know if you have anything you want to add there.
Well, just to put it in economic terms, if you look historically, these periods of pessimism, social indicators decaying, health, depression, suicide, violent crime, they've tended to correlate with stagnation and the growth of ordinary people's incomes. And that, as you point out, that's turning around. I am so optimistic about the US. I think the worst is past us. We've spent our whole adult lives in that period where growth has been slow. It's been a narrative of decline, decay, make America great again, backward-looking stuff. Think of it like stock markets. When after a big bear market, everyone is still super negative and no one wants to own stocks, even after stocks start going up again and the index has bottomed. Like, that's where we are now. The index has bottomed on America socially, and we're up 30% off the lows, and we're starting a run, and everyone's still, it's a bear market, it's still going to go down. No one's paying attention because they're just so conditioned by what's gone before. The growth is going to be really good for a lot of reasons that we've talked about, and that's going to lift a lot of boats. So, the future's so bright, we got to wear shades, is the quick and dirty outlook from Rob.
Well, we're certainly more upbeat than we were last week. Rob is losing his pitch battle against the French, so we have to let him go. The last thing I will just say is thanks to Mark for reaching out to us, longtime listener. You might remember last week we were talking about Ethiopia and Somalia and how Ethiopia has this deal with the break-off region of Somaliland where they're going to get port access in return for shares of Ethiopian Airlines and some other things, and we joked about that. Mark, who's in the aviation space, wanted to chastise us both, Rob, and said that Ethiopian Airlines is a great company and that anybody should be happy to have shares in Ethiopian Airlines. Maybe they're better than Boeing. I don't know. Is it too soon for that joke? So anyway, we will now do some due diligence on Ethiopian Airlines. I'm still not sure that's a great trade when we're talking about access to a port, but who knows? Maybe we'll add Ethiopian Airlines to our innovation strategy. On that note, cheers, and we'll see you out there, folks. Thank you so much for listening to the Cognitive Dissidence podcast, brought to you by Cognitive Investments. If you are interested in learning more about cognitive investments, you can check us out online at cognitive.investments. That's cognitive.investments. You can also write to me directly if you want at jacob@cognitive.investments. Cheers, and we'll see you out there. The views expressed in this commentary are subject to change based on market and other conditions. This podcast may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. Cognitive Investments LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Cognitive and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.cognitive.investments. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor.